So, hi guys, welcome back. Today we're going to be looking at various types of REITs. REITs stand for Real Estate Investment Trust Funds, which are companies that own and operate basically income producing real estate. So I know all around the world we've seen inflation skyrocket, we've seen the markets and the stock market beginning to crash, and generally in this time you want to be looking at safer investments to look at. And because real estate investment trust funds, basically they actually own property, they have a more stable grounding in terms of their business model as opposed to like tech stocks, which are slightly more volatile. And this generally means that they're safer investments, they're less volatile, and they generally also have a very good dividend yield. So that's probably a very good investment, especially at a time like this where there's a lot of market volatility and unrest in the economic system. So the first REIT we're going to be looking at is Farmland Partners. This stock is currently at $14.43. It is not making, doesn't have a positive PE ratio yet, but it does have a subpar but decent dividend yield of 1.66%. So why invest in farmland? So farmland generally has traditionally a very high demand because people need to eat regardless of the economic condition that you're in, and the population is growing on a global level. The world's population is expected to reach about 10 billion over the next 30 years, and at the same time the middle class is expected to grow rapidly in emerging countries, which also increases the demand for farmland because people switch to protein-richer diets once they get richer over time. And stable to declining supply coupled with a steadily rising demand leads to one, recession and inflation resistant returns. So we can see over the last about 30 years between 1990 and about 2020, seen farmland outpace even stocks, which are up 8.51% on an average increase. Real estate at 8%, which was kind of like a greater category of farmland, but farmland being a smaller category of real estate. Then we've seen bonds at about 5.5%, gold at about 5.5%, but farmland all the way at about 10.5% on annual average returns. So farmland has outperformed stocks, bonds, gold, and even traditional real estate over the past 3 decades. And one of the main reasons why farmland outperforms is because its returns are more consistent. You may earn a little bit less during bull markets, but you don't lose as much during bear markets, which makes it a very safe and not very volatile investment. Over a full cycle, the average returns end up being higher, and farmland kept appreciating even during the GFC when most other asset classes lost substantial value. Over here, we saw real estate down, we saw stocks down, we saw gold rise, obviously, and we saw bonds remain relatively stable during that time. So today, farmland is a particularly attractive investment because we're experiencing high inflation and crop prices are surging due to the war in Ukraine. So Ukraine and Russia are some of the world's biggest grain exporters, but right now Ukraine farmers are fighting for their lives and Russia is isolated due to the sanctions put on them. And as a result, US farmland is becoming more important for the world's demand of food, and the value is surging. So we've seen the price of wheat up 100%, so the price of corn farms up 80%, and the price of soybean farms up 92%. So how can you invest in farmland? So there are two main options, which are publicly listed real estate investment funds and crowdfunding. So the top pick among REITs is Farmland Partners, according to this author, and it is currently at a price that is estimated about a 10% discount to its net asset value. It's particularly well positioned to benefit from the growing demand for farmland because it also has an asset management business, which is poised for rapid growth as investors turn to farmland. It does have a competitor, which is the Gladstone Land Corporation, but because of some, it has had some legal troubles in the past, Farmland Partners. Because of that, the stock price is slightly cheaper, which does make it more risky, but also a more lucrative investment. So if we're looking at Farmland Partners, we're looking at their earnings per share. It has been quite volatile, and they don't have a positive earnings per share as of right now. And their dividend is quite low, but they are a pretty safe bet in terms of appreciating farmland. It is one of the more fringy investments, and we'll be looking at safer investments later on in the video. But if you do want to invest in something that is farmland, which has traditionally outperformed, Farmland Partners is a pretty solid bet, and they haven't actually lost too much of their stock price over the last couple of months as compared to like the tech stocks or even business stocks in general if you're looking at the S&P 500. The next company we're looking at is Sachem Capital. This is another REIT, but they don't specifically focus on a type of land as Farmland Partners did. Once again, it has had a relatively stable stock price. We're looking at a very low PE ratio of just 12.5, which is quite good, especially in the stock market as of right now. We're looking at an insanely high dividend yield, about 9.5%. So, as of writing this article, it was at 10.1%, but currently it is at 9.43% as a dividend yield. So, Sachem Capital is a hard money lender based in Connecticut. Hard money loans are short-term mortgages that are secured by real estate. A regular mortgage might have a term between 50 and 30 years, but a hard money loan generally has a loan of 1 to 3 years. These loans are a much higher interest rate and are underwritten based on the value of the collateral property, allowing for a much quicker process from application to financing. These loans are primarily used by real estate investors who are looking for short-term financing to fix up a property before selling it off, or to take advantage of a great price while they're waiting for a longer-term financing to be approved. So over time, we've watched and followed coverage of SACH. They've grown from a small area hard money lender to one that has loans in almost 14 states with a primary focus on Texas, Florida, and Connecticut. And this steady stream of growth and development has been financed through careful decision by their management team. Firstly, SAC does issue common shares, which are accretive, but unlike other small mortgage-focused REITs, they're not so desperate to grow that they put common shareholders' interests aside. So they don't constantly flood the market with common shares, which would be extremely expensive for SAC capital cost-wise, and they would dilute the shareholders' investment as well. But instead, they've taken to a routinely issued fixed-rate baby bonds, of which SAC recently did issue some more recently. We find this choice commendable for a couple of reasons. Firstly, in a rising interest rate environment, getting a fixed rate debt at reasonable price is intelligent. And secondly, SACH has also been able to systematically lower its cost of capital with each issuance. So next, looking at, once again, their key ratios, we can see that as compared to Farmland Partners, SAC has remained quite the bit more consistent, growing from about 0.17 cents in earnings per share in 2014 all the way up to 0.44 in the last trailing 12 months. We have a very solid dividend yield and a payout ratio ranging between 50% and 100%, which is generally pretty solid as time goes by. They do have a subpar return on equity, but that is expected given the business that they are in, which is real estate. But the main thing I want to note is the book value per share in the trailing 12 months is $5.50, while the stock price is currently trading at $5.09, which basically means they have more assets under management per value than their stock price as of right now, which is generally seen as a very good investment, and you're for sure getting more bang for your buck because the value per share, the asset value per share that you're getting is $5.50, while you're only paying $5.09 per share. On top of that, you have an extremely low PE ratio of just 12.5 years and an extremely low dividend yield, an extremely high dividend yield of 9.5%. And then the third REIT we're going to be looking at is WP Carey. It's quite a bit larger than SAC, which was only just a couple of $100 million. This is a bit more institutionalized. It has about $15.5 billion in market cap. It is quite a bit more pricey. We're looking at about a 30 PE ratio, but once again, a very, very healthy dividend yield of 5.2%. On top of this, looking at their March quarter earnings, we can see their revenue was up 10% year over year, their net income up 200% year over year, their diluted earnings per share up 182% year over year, and a very, very healthy net profit margin of 46%. So why would you want to buy WP Carey? So it is probably the most diversified out of all the three. It has triple net lease REIT that reported a very solid quarter one at $1.35 per share and was up 10% year over year. And WPC reaffirmed its previous guidance of being between $5.18 and $5.30 for 2022, with about $1.5 to $2 billion in acquisitions planned. The triple net lease is superiorly structured due to have during inflationary times. In these times, the tenant gets low rent but is responsible for most property level costs. Things like property insurance, taxes, and routine maintenance are responsibility of the tenant, and in turn, the landlord has minimal exposure to the expenses that might be driven higher by inflation. They're basically protecting themselves and putting most of the responsibility on the tenant, but in turn, the tenant does get a lower rent as well. At the same time, most leases do have some kind of provision for raising the rent, and they're often tied to the consumer price index as well. So these rent increases are not instantaneous. In other words, rent doesn't go up the month that CPI is reported. Instead, they're used to calculate rent increases at predetermined time. For example, a lease might reset rent annually based on the average CPI over the past year. In quarter one, we saw confirmation that inflation is starting to have a positive impact on WP Carey. The same-store rent growth was up 2.7% compared to just 1.8% in the prior quarter, and growth will accelerate as more leases hit their reset date. And because of the CPI going up, obviously they'll be able to increase their rent as well. Once raised, future rent increases will be calculated on the newer, higher base rent. So high inflation will benefit this, as it will drive WPC's same-store earnings for years, even as inflation starts to moderate. WPC's average remaining lease term is about 11 years, and a couple of years of high inflation would result in those leases being far more profitable than originally expected, obviously because of the deal that was brokered between the tenant, who was willing to pay this higher price for a lower upfront rent cost. Meanwhile, the WPC's largest expense is interest. Like most REITs, WPC uses a fixed rate debt. If a REIT has to refinance at a higher rate, this having a headwind of FFO and cash flow. Here too, WPC is well positioned, having taken advantage of historically low interest rates to refinance their debt as far as they could, which makes it a lot cheaper on their interest rates, and they do not have any meaningful maturities until 2024. That refinancing risk won't be an issue until 2024 to 2026, and who knows where the rates might be then. Many are projecting that a recession will happen by or before 2024, in which you can expect rate to come back down then by regardless, which means that it won't really have a big impact on WPC's business. Regardless, WPC has a few years of inflation to work its magic on its revenues before rising expenses do become a possible risk, but until then, you're still looking at 2 to 3 years of a solid investment anyway. WPC reports a strong quarter, shows that inflation is benefiting its current income, reaffirms guidance because Amazon had a lousy earnings report. WPC sells off with the rest of the market. We'll take advantage of this opportunity and buy some more before the price goes too out of reach. So looking at the stock price, we are once again seeing that it hasn't been impacted too much by the pandemic. By the recent sell-off, looking at about an 8% compared to maybe 60 to 70% for many tech stocks, and even about an 18% decline for the S&P 500. Do note that it is quite a bit more pricey than SAC, but it is much more solid buy than Farmland Partners. Looking at their key ratios, we can see that the earnings per share has fluctuated. It went high about 2018, took a dip during the COVID pandemic, but we are expecting this to rise in the future. It has very solid dividends, but their payout ratio is incredibly high, but they are managing to hold that on for about a decade now, so it doesn't look like there's something to worry about there. The return on equity, once again, is relatively low, obviously due to the business that they're in, and their book value per shares are currently at about $40 compared to their stock price of about $81. So they are looking at a book value per share about 2 they are looking at a price to book value at about 2 compared to SAC, which is much, much cheaper. So today we looked at 3 different companies. We looked at Farmland Partners, which is a bit more of a fringy investment, but it can be probably the most profitable one due to of how specific the REIT is focused on. We looked at SAC, which is slightly more diversified, but is still a very, very small company at just $200 million in market cap, which does have a very low PE ratio, but also a very high dividend yield. So we're looking at a win-win there. And on top of that, we're looking at the book value per share of almost being a 1-to-1 ratio, with the price actually being cheaper than the book value per share. And the last one we looked at is WP Carey, which is probably the most established out of the 3. It does have a kind of a pricier PE ratio at about 30, but it does have a very, very solid dividend yield of 5.21%, and it is the most diversified out of the 3. So I hope you enjoyed. I hope you find this video useful in terms of making some investments. Once again, we're looking at REITs because they're traditionally stable businesses compared to tech companies and finance companies. These are companies with generally high dividend yields, which is once again a very good thing when looking at long-term investing. And they're also safer and more inflation resistant than the rest of the market. So I hope you guys enjoy. I know I haven't posted for about 3 months. I've been quite busy, but hopefully I fall into kind of a recording schedule over the next month or so, and I'll see you in the next video. Thanks. Bye.